So, when Apple announced it was going to use Google's Gemini to power the next generation of Siri, a lot of the talk was all about the tech. But honestly, the real story, the one that should matter to every single investor, isn't about the code at all. It's about capital. Okay, let's dive into what is truly a masterclass in capital allocation. And it all boils down to this one single question. How do you win the AI race? A race that's completely defined by massive, expensive infrastructure without getting sucked into the black hole of building the entire racetrack yourself. You see, to really get why Apple made this move, you have to understand the incredible pressure they were under. They were basically fighting a war on two fronts. On one side, they had a product, Siri, that was, let's be honest, falling way behind. And on the other, they were staring down the absolutely staggering cost required to even have a shot at catching up. And this slide? This just lays out the dilemma perfectly. On the left, you've got the product problem, right? The jump from Siri's simple one-and-done commands to the kind of complex, multi-step thinking a model like Gemini can do. But to make that jump, you got to look at the right. That chart is the price tag. That's Google's capital expenditure, their CapEx, soaring up to $52.5 billion, mostly to build the exact kind of AI infrastructure we're talking about. And look, it's not just a one-time construction cost. It's the relentless, ongoing R&D spend. This chart shows it all. Google just consistently outspends Apple on research and development. For Apple to try and close that gap, to build a Gemini-level model from scratch, they would have had to completely rip up their legendary super-efficient operating model. It would have changed the company's financial DNA. So, when you see all that, the Gemini partnership suddenly stops looking like they're just playing catch-up. Instead, it starts to look like an incredibly smart strategic pivot. Apple made a very deliberate choice here. Trade the brutal economics of building servers for the much, much smarter economics of licensing software. Let's just break down the two roads they were looking at. You've got option A, what we can call the builder's trap. That means billions in upfront cash, assets that lose value every single day, and a deployment that would take years. Or you go with option B, the Apple way. This move brilliantly turns a huge capital expense into a predictable operating expense, just a licensing fee. They get zero depreciation, they get to scale it immediately across 2 billion devices, and this is the key, they get to keep their cash. And this sentence right here, this is the whole ballgame. This is the entire financial genius of the deal summed up. They are intentionally stepping away from a low-margin, capital-destroying business to double down on what they do best, create incredible, high-margin products and experiences. Okay, let's get into the hard numbers, because this strategic decision has some truly staggering real-world consequences. We can actually put a price tag on this choice. And boom, here it is in black and white, well, blue and green. This chart just shows the two strategies in action. Look at that blue line. That's Google, the builder, with their CapEx shooting up to $52.5 billion. Now look at the green line. That's Apple, the licensor. They've intentionally kept their spending under $10 billion. That massive growing gap between those two lines, that's the story. $43 billion. That's the difference. In a single year. You can basically think of this as the AI infrastructure tax. It's the cover charge to get into the AI race if you insist on building everything yourself. And it's a tax that Apple has figured out how to completely avoid paying. So who cares? Why does dodging a $43 billion bill actually matter? What's the end game here? Well, it all comes down to protecting the one metric that matters most to any long-term investor: the company's power to generate cold, hard cash. Because they're not pouring all that cash into servers, Apple manages to turn an incredible 28% of its revenue directly into free cash flow. We're talking nearly $109 billion in 2024. And as the note here points out, that's a world away from Google, whose cash flow gets squeezed by all that capital spending. This right here is Apple's unencumbered cash engine, just humming along. And that discipline right there is how Apple maintains what you can only describe as a fortress balance sheet. A return on invested capital over 44%, that is elite. And it's only possible because they keep their invested capital base so lean. They outsource the heavy, expensive stuff, and in doing so, they protect their margins and their cash position. And that brings us to the grand finale, the ultimate payoff. What does a company do with almost $109 billion in free cash that it doesn't have to sink into building infrastructure? The answer is pretty much the holy grail for shareholders. The answer? Over $110 billion.
That's the amount of capital Apple returned directly to its owners, to its shareholders, in 2024 alone. That's through dividends and just massive share buybacks. I mean, let that sink in for a second. Apple gives more cash back to its shareholders in 1 year than most Fortune 500 companies even make in total sales. And as the slide says, loud and clear, this is a direct result of their capital light strategy. This kind of shareholder yield would be absolutely impossible if they were also lighting tens of billions of dollars on fire every year building data centers. So let's tie this all together. The investment thesis here is just beautifully simple. 1. The product problem is solved. Siri gets a massive upgrade overnight. 2. Their incredible margins are protected. A licensing fee is just a fraction of the cost of building out server farms. And 3. A torrent of capital is unlocked. By sidestepping that AI tax, Apple keeps its $100 billion a year shareholder return machine firing on all cylinders. Which really leaves us with one final, and I think pretty profound question. In an era where everyone else is writing blank checks for an AI arms race that has no finish line, could it be that Apple's legendary financial discipline isn't just a part of their business model, but is in fact their most powerful and lasting competitive advantage?